All right, welcome everybody. Hold on, I gotta set up a few things. All righty, happy Wednesday, KW Metro San Diego. This is Broker Bob coming to you live from Chicago, here for your weekly meeting. Yes, your monitor's is working correctly. I'm not Sarah, I'm not Jacqueline. They're out at a leadership retreat, and they've asked me to step in and do the MC. And by the way, I have MC'd in the past, so I think I kind of know what we're doing. Want to welcome everybody to the meeting. We got a great guest speaker today on 1031 exchanges. So looking forward to that being done. I see Brandon on here online. So Brandon, when you're ready, I will bring you into the fold. Let's go into, guess what? We don't have a slideshow today, so you just get a look at my pretty face. But I am actually going to share my screen with the agenda, so it might be a little bit more helpful for visual for some people. So let's give a welcome to new agents that joined our office. Ponderine Sinatra and Eric Gonzalez. Welcome to San Diego Metro. And now let's do some bucket fills. Who's got something nice they want to say about somebody or something that happened this week, or give somebody some praise? We would love to hear them. I see people are still logging online. Don't be shy.
Hey, Broker Bob, congratulations.
Hi, Andrea.
An awesome dude.
You got a praise?
For you.
Oh, for me? Why?
Because you're awesome.
I appreciate it. Thank you very much.
No, I mean, we're so lucky to have you. And I'm glad that you got honored publicly, because we get to appreciate you privately. So thank you for all you do for us.
I appreciate it. Unfortunately, I wasn't there for the award ceremony. I'm glad that we had agents participate in the Circle of Excellence this year, and they went and got their awards, and well deserved, because if they are on the leaderboard, they deserve it for all the hard work. Everybody deserves for the hard work. Okay, any other notables that somebody wants to say? Words of encouragement. Everybody's being shy today, so no more bucket fills. Nobody has anything nice to say about anybody in our office. All right, let's get in then to.
Wait, I'll do one. I want to give a shout out to Nick.
Go ahead.
Is he on here? Nick, are you on here? Our fabulous tech ambassador. Nick is always so generous to my coaching team, willing to help. And even today, he kind of ran my group coaching for me and taught us some ways that we can utilize Zillow to help us, even though Zillow is a competitor, to use their website in order to find more opportunities. So thank you, Nick, for doing that today. I appreciate you.
Thank you, Alicia. Nobody has anything else. I'm going to go into the upcoming trainings we have in the office coming up, and there's a lot. So this Thursday, that's tomorrow, KW Command, run a successful ad campaign with our very own Nick that just got mentioned. That's via Zoom. This Saturday, don't forget, we are painting the town red and doing Power Day every Saturday between now and through the end of the year. Because why? Because it's where the market is. We have to do, our intention is to get everybody out there and powering through their lead generation to capture the market. On Monday, Movement Mondays with Ed and Matt via Zoom. Also next Monday, if you missed the first two parts of the contract series with myself and Mark Miller, who's also leading, you can join us for the purchase agreement next Monday at 1 o'clock. And we also are on next Tuesday at 1 o'clock, where it's a two-part series. So be ready for that. And if you don't know the contract, it'd be a good time to come and listen. If you do know the contract, there's some changes you might want to be aware of as well too. And then KW Command Input with Dan Becker coming up in the training room on Monday. And then on Tuesday next week, KW Command Stay in Touch with Your Smart Plans with Nick. That's via Zoom. And then on Wednesday of next week, we have an Easter egg potluck. More information to follow on that. But I'm assuming there's a sign-up list that I know nothing about. And I can't believe it's Easter. So Good Friday's coming up. I'm excited about that. And then Wednesday, next week is actually an in-person team meeting. So they're going to do a scavenger hunt and red day intro. So be there for that. And then Thursday on the 6th, how to make a design with Nick. Nick is busy teaching classes with Command. And if you don't know Command, you have no excuse. And then next Thursday, I will be teaching Master the DISC, the DISC. This is all about behavior. So if you're a newer agent and you're new in sales, there's this old adage called mirror and match the people you're communicating with. You need to understand how they are cut from, how do they think about things. And I'm going to teach you that, but I'm also going to teach you, based upon your own personal DISC, what are the best methods of lead generation? That's the bonus. There's like 70 plus ideas that I'll give to you for attending that class. Good Friday, I'm excited about that. I get a 3-day weekend, sort of, on the 7th, so the office is closed. And on the 13th and 14th, Quantum Leap with Ashley in person. So Ashley, if you are on, can you unmute and give a little speech on that? Only if she's on, and I don't know if she's here. Okay, she's not here. So we'll have her do a little shout out at the next week's team meeting on it. Quantum Leap, I highly recommend if you haven't done it, please get your butt to it. All right, next up, Movement Mortgage. Eddie, Anthony, Amanda, or Wes, which one's going to speak today?
You guys got me and Matt today.
Perfect.
So I've actually missed the last 2 weeks, so I apologize if this is repeat for you guys, but 2 things that have recently come out. Number one, Movement, we finally launched a lock and shop program. I know that some of you guys have been asking about that. So I did place some flyers throughout the office, giving you guys some small bits of information on it. It's a 90-day lock, 45 days, to try and find that property, 45 days to be in escrow with that lock. So if you guys have any questions on that, feel free to reach out, but we're super, super excited about it. Also, I know that there's been a lot of questions, zooming around in regards to the new CalHAFA Dream for All program. We are actually a little delayed on our side with Movement. We will officially be launching it on our end on April the 5th. That doesn't mean that we can't start taking applications on it. So we can still meet with your clients. We can still start gathering all of their information, getting all the documents that we need. We just can't start processing anything, unfortunately, until April the 5th. So if there's any updates on that, we'll make sure that we let you guys know. But it's a fantastic program. We're super, super excited to get this added on to our, roster of different loan programs. But yeah, anyways, if you guys have any questions, feel free to reach out to us.
All right. And Matt, you're going to be quiet today?
Just Movement Mondays with Ed and I, 9 o'clock. See you guys there if you can make it. Talk to your loan officer, whoever that is. If you haven't recently, the market is definitely volatile. 7 lock alerts in the last 13 days. So if that doesn't tell you something about where the market's at, talk to your loan officer, have a conversation. Thanks, guys.
All right. Thanks, Movement. All right. Let's give some shout outs to, we don't have slides, but I'm going to give a shout out in the coaching program on Team Alicia. Tinu got another BRBC sign. If you don't know what a BRBC sign, then you didn't come to my classes last week, but it's the new buyer broker, and that's what it's called, the new form, BRBC. Congratulations, Tinu. And that's a new form. So I'm glad that a newer agent is using that form. And any broker updates this week? No, nothing important to say, but keep doing the best job you guys are doing. I'm really proud of all of you. All right, let's do some property pitches. We have time for some property pitches before the main event. So who has something upcoming that they want to promote? Nobody has a listing? Judy, usually you've got a listing you want to promote.
Hey, Robert, can I pitch something?
Yes, you can, Mr. Becker.
All right, it's not exactly a listing, but coming up in either October or November, I'm putting together a group of agents and their clients, if they want to go to San Miguel de Allende, Mexico, where they have a huge expat population. And we are going to do a little field trip down there for 3 or 4 days, see the town, see some areas, learn about buying property in Mexico from an out of country area. So if anybody's interested in that, please reach out to me.
Love that. Thank you, Dan. Anybody else?
Yes, I could pitch my property, but I have 2 offers right now. So if anybody has a interest in living in Rolling Hills for under $850 is my top price right now. And it is $819 to $849. I really mean $850, right? Anyway, so that house is going to go fast. But if anybody's interested, and also I've noticed that a lot of people are not shadowing me lately. Did I do something wrong?
No, it's just that they're not out doing the shadowing and doing the activities they need to be doing. So this
That's
is a
good.
time for
I'm
me
glad
to
they are.
remind
But
them.
if they do want to shadow me, I'm available all the time. So just let me know how I can help.
Thank you, Judy. And
I
have
would
a
love to shadow Judy.
What was that?
I would love to shadow Judy.
Okay. Reach out to Judy.
Just
Thank you.
text me your contact information and I will put you on this weekend.
Thank you.
All right, I have a property pitch. I have a listing coming up. Anybody have buyers in Mission Hills, Hillcrest, North Park? It's a beautiful property, 4-bedroom, 3.5 bath, completely remodeled from top to bottom, all stainless steel, new roof, new foundation. Price is $600,000. Anybody have a buyer in that price range in Mission Hills? Amy, what'd you say?
I said, wow, to the price.
Yeah,
I
I'm
don't
joking.
believe you. Is this?
April
how
Fools
much?
is on
How
Saturday.
about
Are you kidding?
$1,600,000 sounds more like it.
Actually, it's 600,000, but that's my early April Fool's joke. And I want to see if you guys are paying attention. So
Oh, can we
April
bring
Fools.
back, can we bring back the dad jokes?
I
from
almost
years
bought
ago?
All right, without further ado, your broker of record and the elite broker can have a little fun every now and then. Without further ado, let's get into our featured presentation with Mr. Where am I seeing him? Where'd he go? Daniel Burns.
Right here.
Okay,
All
you.
real
Or
quick.
Brandon Burns.
Yes, my name's Brandon Burns, the president of Investors 1031 Exchange. We're headquartered here in Solana Beach. Been by your office tons of times. Always love talking to Keller Williams Metro folks. Should I put up a slide or should I just talk? I noticed that you didn't have slides. What's the best thing for everyone here today?
Well, I didn't have a slide because our slide person is out. And
Gotcha.
but visual sometimes is good for people to learn to see something. It's your choice. So all you, and I gave you co-host capabilities to share.
And I'm gonna share my screen here. Hopefully everyone can see it. What I don't want to do is sit here and kind of run through some dry numbers and a bunch of stuff that you may or may not remember. So what I want to do kind of quickly is before we go into the presentation, there's 4 things, and these are the 4 things that you need to know or that can help you potentially get more listings or double into deals using a 1031 exchange. So the first one, as we go through the slide, there's going to be a time component. So once someone sells a property, 2 clock start, we'll talk about what that means, but that's point number 1. Point number 2, as we go through this, is the IRS doesn't care about what someone paid for a property, how much they owe on the property. They only look, as it relates to a 1031 exchange, they only look at the top line number. So they look at the gross sales price, and you can subtract a few non-optional closing costs, and the seller has to buy 1 or more replacement properties that equal or exceed that number. So as we go through the slide, that's point number 2 that's important. Point number 3, the seller can't touch the money. They have to use a 1031 exchange company. And number 4, there has to be what the IRS calls a continuity of taxpayer. Essentially, the IRS wants to still track those deferred expenses. And if someone sells and the sale shows up on one tax return and the buy shows up on another tax return, then it's difficult for the IRS to track that. So they disallow the exchange. So you can always change who's on title before the exchange or after, but you cannot change the taxpayer in the middle. So as we go through that, those are kind of the 4 key points to remember. I put some contact information here. Feel free to follow me on Instagram, social media at Brandon.the1031guy, or you can always call our office. We like slides. Okay, good. I just saw that. So Investors 1031 Exchange, we're a qualified intermediary. Like I said, our headquarters are up in Solana Beach. We're just down from the Belly Up, if you folks know where that is, on Cedros. We do all kinds of exchanges. It is important to note, so there's really two sections of the tax code that talk about tax savings for property owners, right? So everyone here should know section 121 is if someone's selling their primary residence, they get $250,000 or $500,000 tax-free if they're single or married, as long as they've lived in the property for 24 months. That's true if it's someone's primary residence. That does not apply to investment properties. What does apply to investment properties is if someone's selling an investment property and buying an investment property, then they can roll the entire amount over as long as they jump through the hoops that we discussed, and we're going to talk about those more in depth. But as long as they jump through those hoops, they can roll the entire amount of gains over, and there's no taxable event, or there could be a partial taxable event. Now, a 1031 exchange is not, it doesn't remove the taxes, it just keeps taxes from happening. So for a taxable event to happen, two things have to happen. One, you have to make money, right? You can't pay taxes if you haven't made money. The second part is you have to take possession of that money. So even if I was the world's greatest investor of all times, and I bought Apple stock, put 10,000 of Apple stock into the day that it went on the stock market, and now that Apple stock, maybe that's worth $10 million, I haven't had to pay taxes along the way as it grew, right? I only have to pay taxes on that Apple stock whenever I sell that Apple stock and I take possession of those dollars. So the same principle applies here for real estate people doing a 1031 exchange. As long as the seller doesn't take receipt of that money, it keeps a taxable event from happening and defers those taxes to a later point in the future. All right, so there's several different types of exchanges. The most common type of exchange, or a normal exchange, if you will, is a forward exchange. That means you sell a property, you buy a property. A reverse exchange, you can do backwards. And that can take some of the risk off the table, but it is a little bit more expensive and a little bit more difficult to do. A reverse exchange, you purchase the replacement property, then you sell what you have. And lastly, there's a build to suit or improvement exchange, where someone, if they have some leftover money after buying a replacement property, they can fix it up within that 180 days, the time limit that I mentioned that we're about to go into a little more depth on. So one of the things that's important, one of the questions that we're getting a lot right now is, how long do I have to live? How long do I have to have the property be an investment property before I potentially could live in it? Or, what if I wanted to do this alternative use with it? So the tax code doesn't talk about time as it relates to a 1031 exchange, and that's important. What it does talk about is your intent. So you're selling an investment property that at the time of the exchange, you have to intend to hold it for long-term investment. So this morning I was on the call with an exchanger and he said, well, I'm exchanging this investment property, but at some point I'd potentially like to move into it. When can I do that? And my comment to him was, first of all, it's important that your intent today be that it's an investment property. So the more you document that intent, the better off you're going to be. Send a letter to your realtor, to your mama, to your best friend, send emails and say, I'm so excited to hold this for long-term investment purposes. Then after some time, if the intent changes, the intent's been documented and the IRS has come out and said, hey, we know that intent can be kind of difficult sometimes to quantify. So if you hold an investment property for 2 years and report it onto tax returns, most of the time that will prove your intent. So that's important to understand when people ask about how long do I have to hold a property before I can move into it, or before a use can change, or things like that. One thing that the IRS has also done is they've said, hey, if you're buying a property to fix it up and sell, just like if you were buying a car to fix it up and sell, that doesn't qualify for the tax break. So a flip does not qualify for the tax deferral treatment of a 1031 exchange. Does that make sense for everyone before I kind of step into the next things we're going to talk about?
Yes, thank you.
Okay, cool. And as we go, please feel free, type in questions. I'm certainly glad to go into a little bit more depth on any of these things that we talk about. So remember, we said there are 4 key points. And the second key point was that the investor has to buy equal or greater to their net sales price. The net sales price, the IRS defines as the gross sales price minus non-optional expenses. Non-optional expenses are realtor, title, escrow, 1031 exchanges. Loan points, not non-optional. Appraisal, not non-optional, or anything else potentially related to the transaction. Amy has a question here, and she said, you noted not allowed property acquired to develop. Does that mean buying a vacant lot to build a single family home to rent out? So great question, Amy. So the IRS is going to look at the settlement statements. So if you sold a property and you're buying a vacant lot, that works. But you can't include any of the costs for building that single family home. So they're just going to look at those settlement statements. If you were planning on buying the land and holding it as an investment, especially in California, where the permitting process can take a while, definitely qualifies for an exchange. If you were in another state, let's say Nevada, right, where you can just kind of build anything anywhere, and maybe you don't need a ton of permits to build and sell fairly quickly, the IRS would classify that more as a flip rather than a longer term investment. In California, buying a single family lot and building on it, you're probably looking at 2 years plus anyway. So you could do that, but the key would be whatever you sold, you have to buy equal or greater. And it probably would be tough to buy a vacant lot and have that be equal or greater to what someone sold. Does that answer your question? Okay, fantastic. There's 2 ways there's 2 financial metrics the IRS is looking at, and 2 ways they can get you and incur a taxable event. The first one is if the seller touches any of the money, right? So that's point number 3 here on the slide. And you guys are adults, I don't want to read slides to you. So point number 3, any money that someone touches, that's going to be taxable, but also you have to buy equal or greater to the net sales price. So, some people today are saying, hey, I've got this property, it's gone up $1 million in value. I'm going to sell it and I'm going to take that $1 million and I'm going to roll it into another property. But maybe they sold the property for $1.5 million. Maybe it had $500,000 worth of debt on it. That will incur a taxable expense and cause a taxable event. And a lot of people today are surprised by that. So it's really important that as you're talking to your clients, they know that it's really important that to buy that replacement property equal or greater to what they sold. And you can subtract those non-optional expenses, but you can't subtract debt. You're really looking, if you sell for $1 million, you got to buy $950 or more roughly. So does that make sense before we go on about those 2 financial metrics? Amy has another question. Not sure if you answered this. If you buy less than the sales price, does the amount not reinvested get taxed, or does all of it get taxed? That's a very good question. It's just the difference. So let's say somebody sold a property, an investment property for $1 million, and there was $50,000 of realtor, title, escrow, 1031 exchange charges. That means their net sales price is going to be $950,000. If they bought a replacement property for $900,000, only that delta, that variance would be taxed. They'd only be taxed on $50,000 rather than the whole thing. So you can always do a partial exchange. And that's also true if someone takes out some money, they only are going to pay taxes on what they touch, not on the whole thing. So a 1031 exchange is not an all or nothing scenario. you can do a partial exchange, pay some taxes and shelter the rest of those taxes. That's a great question. So what are like kind properties? Section 1031 is called the like kind exchange. So it may seem inherent, right? It may seem logical that if you sell single family, a like kind might be single family. That is not how the IRS defines it. The IRS defines like kind property as any real property. So you can sell a single family and you can buy multifamily. You can sell multifamily, you can buy land. Sell land, buy a hotel, sell a hotel, buy single family. One good way to think about this is if the title is held at the county, it is almost always real property. If the title is held at the DMV, it is almost always not real property, right? So non-like kind properties, shares in a corporation, not real property, right? LLC interest or partnership interest, syndications, not real property. Mutual funds, 401ks, cash, or flips, not real property. Does that make sense to everyone? What you can exchange kind of in and out of before we go any further? Okay, good. So, oh, looks like there is a question. Let's see here. Yes, okay, good. So next is the timeline. So the one important part that we talked about so far is the net sales price, right? So have to buy equal or greater to what sold minus those non-optional closing costs. Now, the second major point that we're talking about, we discussed at the beginning, is the time. So once a property sells, 2 clocks start and run simultaneously. 45 days to come up with a plan and 180 days to buy one or more properties. Now, that starts whenever the property sells, right? So whatever date is on that settlement statement, that's when those clocks start. If you have an exchanger that's potentially worried, a seller that's worried about those timelines, if you can get a longer escrow or you can put an extension in possibly, then that can really lengthen out that time period from the day that the seller is worried about it, because those clocks don't start until they no longer own the property. So in that 45-day time period, a lot of people get really focused on how they can identify properties. And that's not as big of a deal as people make it out to be, in my opinion. The key is that they either have to have purchased replacement property by midnight on the 45th day, or they have to have written down a number of properties that they may or may not buy. At midnight on the 45th day, the properties they've written down are the only properties that they can buy tax-free going forward. There are no ifs, ands, or buts. Unfortunately, the IRS wants people to pay taxes. So a common question is, what if we write down 3 properties, we identify 3 properties, and then all 3 get sold to someone else? Unfortunately, the IRS is going to laugh and take the money if that happens. So there's really not any wiggle room with that. So that's very important to understand.
Can you real quickly reiterate how many properties they're allowed to identify?
Yes, that's what we're going to talk about here. So as someone identifies property, there's 3 different ways or 3 different limits on what they can identify. So most people choose to use the 3 property rule. On that one, the limit is the number of properties that someone can identify. So 3 properties, any location, any amount, no other limits. And that is the most common. Secondly, there's another test that you can use, and the limit, instead of being on the number of properties, it's on the total value of all the properties. So you're not limited on the number of properties. You could identify 100 properties, but their total value cannot be more than double of what someone sold. An example of that, last summer I had a exchange client that sold a 3-plex over in Ocean Beach for 1.5 million. And he was dating a travel nurse. And he said, hey, I want to leave San Diego. I want to go with this travel nurse and I want some income. So he said, I think I can find some great income buying some rundown properties in Columbus, Ohio. Maybe not what I would have done, but that's what he wanted to do. So he went and he was able to identify an unlimited number of properties as long as their total cumulative value did not exceed double what he sold that triplex for. He sold it for 1.5. So an unlimited number of properties, as long as their total value didn't exceed 3 million. So he identified 15 or 16 single family homes, and I think he closed on about 10 of them, all at about 150,000 each. So that's the second rule. The third,
may I ask a question?
yes.
So in that case, that gives clients the opportunity to identify potentially more than three, because oftentimes people are buying just one for one property, right? They're trading up or trading down. So that 200% rule, it's like I can identify unlimited number, and of those, I may only choose to spend up to what I sold my other property for.
Correct. Yes. So we're working with a little bit of a matrix here, right? So the first rule is that you have to spend all the money and you have to buy equal or greater than what you sold. The second limitation is if it's going to take more than 45 days to close on the replacement, then you can only choose a certain number, right? So the first rule limits the total number of properties. The second rule, the 200% rule, limits the value of the properties. So the 3 property rule, which I'd say 80% of clients use, the limit is the number of properties. So they can say, okay, I want to buy this one property. Maybe I have a backup or 2 in place. On the 200% rule, that's really typically used for someone who wants to diversify. So, selling a property for 1.5 million, they want to buy a whole bunch of homes for 150,000, or selling a property for 2 million, want to buy 3 or 4 properties for, $500,000, $600,000, $700,000 each. So again, most people use the 3 property rule, which limits the amount you can identify at a max of 3. Sometimes people use the 200% rule. The third rule, I don't recommend, and I've only seen used once. There are no restrictions on what you can identify, but you have to close on 95% of what you identify. So you could identify 5,000 properties, but you have to close on 95%. And if someone identifies 20 properties or less, they pretty much have to close on them all, right? So unless you've identified 20 properties, 95% is all of them, right? So 19 properties or less have to close on all of them. So that one is very scary. I see almost no one using that limitation, that rule. Again, I see about 20% of our clients using the 200% rule, and then 80% of our clients use the 3 property rule. Does that make sense for everyone on the call before we go forward? Because that is important. A lot of people get really kind of tied up in this, but again, this is just as someone puts together a plan, what kind of plan are they able to put together if it takes longer than 45 days to close on their properties?
I have a quick question.
Yes.
It's going back a couple of slides, and it's about the third thing on the list about, go back a little more. I think forward one more after this one.
Okay.
There was one question I had about if they add cash, like, is that the difference if it's not exactly the same amount in the like kind?
So someone can always put in cash. So one of the things that's important to remember about a 1031 exchange is it's really more of a personal financial matter than it is a real estate thing, right? So the IRS isn't going to look at certificates of occupancy. They're not going to look at comps. What they are going to look at is you've made money. Are you taking possession of any money? And so if you put additional money in, they don't care because you're not taking out money for them to get, taking possession of money to get taxed on it. They're just looking at, are you buying equal or greater? Are you rolling all the cash? Or if you take some cash out, they just want to get their piece. So someone can always buy something more expensive. They can always put more cash in. The IRS is just trying to figure out if money comes out, we need to make sure we get our piece, right? The IRS wants to get their piece of any money that gets touched.
Okay, so the part where they add cash, that doesn't really have to do with having it be close to the same amount as the property they just sold.
Yeah, so essentially there's a high watermark, right? So using again the example of $1 million,
Mhm.
and there's, let's say, 5% in non-optional closing costs, 950,000 is the high water mark. That just kind of picture there's a government worker sitting in a windowless room and they're looking at someone's tax return like, okay, they sold for $1 million, they've got 50,000 of non-optional closing costs. How much did they buy it for? Okay, is it above 950? Great, we'll continue to move forward. If it's below 950, okay, how much taxes are they going to pay? Right. So that's what the IRS is going to do in that situation.
Oh, okay. So in that situation, if it was less than $1 million or 950, then they couldn't do like 50,000 to make up the difference of their own money.
Yeah. So they can always put more money in. The IRS is going to look at those settlement statements, right? So you have a settlement statement, says sold for $1 million, and there's a line item, escrow, title, 1031, realtor. Say, okay, 950 was the net sales price. Then they look at the next settlement statement, or two. Let's say you could buy one property, you could buy two. They add them together and say, okay, well, how much did they buy? And they add them all up. If it's only 900,000, then they say, okay, we're going to tax you on that variance on that 50,000. If it's $1 million or $1.2 million or $1.7 million or 4 million, they don't care. They say, okay, it's above that 950, you're good, no problem.
Okay, so if it's less though, that's the part where I was wondering, like, if they just add in their own money, then they won't get taxed on the difference, or is that the part where they get taxed on? They can't just add in their own money.
Yeah, they can add in their own money. So it's just on the settlement statements, right? So
Okay.
the IRS doesn't care where the money comes from. They're just looking at the settlement statements. So if you sell for $1 million and it's 950, and then the purchase price of the replacement property is 900, I mean, there's that gap, right? So you can't, looking at the settlement statements, you can't like write a $50,000 check on top of a $900,000 purchase. Then that would raise the purchase price to 950. But who would do that, right? They would go, a $900,000 house in a condo downtown and say, well, I know that it's for sale for 900. I'll pay you 950. Someone could absolutely do that.
Okay.
Right. But remember, they're looking at the settlement statements and comparing the value of the real estate and just making sure that the replacement is equal or greater.
Got it.
Does that help?
It does. I just wasn't sure about the part where they were adding cash. That's where I was unsure.
Yeah. So the IRS doesn't care where the money comes from. So you sold the property for 950, and let's say that you had $500,000 of debt. On the replacement property, you're buying for $1 million. That money, to replace the debt, right? So you had to pay off a $500,000 loan. On the replacement property, you can go get a loan from the bank for another 500,000. You can write a check for 500,000. You can call your parents and get 500,000. You could go get a hard money loan for 500,000. That the IRS is agnostic as to the capital stack, so they don't care about where that money comes from. They're just looking at those settlement statement numbers,
just to make sure that it's even.
Right. Exactly.
Okay. Sounds good. Thanks.
Great question. I thought there was an ability to trade into a lower price property in a 1031 exchange. They would have to pay taxes on the difference. Is that correct? Yes. So again, so let's say you sell for $1 million and there's 50,000 of non-optional closing costs, and you buy for 900,000. You can definitely do that. And they're just going to tax on the variance, right? So they're just going to tax. If you buy lower, then they're only going to tax you on that difference. So you're only going to have to pay taxes on 950,000. It's an exchange is not an all or nothing thing. So it's the same way if you take some money out. Let's say you took $50,000 out. Again, you would only pay taxes on that 50,000. Took $100,000 out, you're going to pay taxes on 100,000. So any money you touch, or if you buy lower than your net sales price, those are the amounts that you're going to get taxed on. Certainly, people can pay taxes on part of it. That's no problem. Non-optional closing costs is the realtor commission. It is the escrow charge, the title fee, and the 1031 exchange. So those are considered non-optional. Things that are not considered non-optional are loan points or appraisals or other things along that nature. It's a great question. All right, let's see, one more. Do all these rules apply if a client is selling an investment property to purchase a primary residence? So remember we looked at this slide. So non-like kind properties, primary residence does not qualify. So if someone sells an investment property and they buy a primary residence, it does not qualify for the tax deferral and is fully taxable. Andrea asked, how much are the 1031 exchange fees? So 1031, we charge 2 flat fees that go on the settlement statement, $995 when someone sells, $295 when they buy. So all in, it's a little bit over $1,200 to do an exchange. It's great questions. I love this. Next question. What happens when you take some money out to reinvest it back into the property for improvements? Will that portion still be taxed? Yes. If you touch any of the money, or there's money left over that isn't on the settlement statements, that money is going to be taxed, whether you use it for a trip to Cabo, whether you use it for improvements on the property, whether you use it to repair the property, anything like that. If any money is touched, or if there's anything that doesn't show up on the settlement statements, that amount is going to be taxed. All right, Maria asked, can you do a 1031 exchange if you're purchasing a new property of the co-borrower if the purchase is 3 times the amount of the current home they're selling? Yeah, so remember a 1031 exchange is more of a personal financial matter than a real estate matter. So the IRS is not going to look at who co-signed the loan. All they're looking at is the flow of money and how much real estate you're buying. So if as long as the property you're buying is equal or greater to the net sales price, definitely works. You can have one co-signer, you can have your whole family co-sign and all your friends. IRS doesn't care about co-signers. They don't care about the type of money that's used. They just care about that you're buying equal or greater to what you sold. You're not touching the money, and you're doing it within the time frame allocated. All right, so Amy said, opposite of Maria's question, if you own an investment with a partner and you're reinvesting on your own, is your portion of ownership in that first one the only amount that is required to purchase? So I actually really like partnership situations. Amy, can I come back to that partnership question after a few slides? Because it's a little bit complicated. I'd like to address it a little bit further if that's all right. Okay, thank you. So sometimes people wonder, when should a QI be brought into the situations? And these are advanced questions. These are really good. These are important, right? And that's what I'm here for, is to make sure that you guys are always able to give the right information so that the client can make the best decision for their situation. So I had someone call me. It was really terrible. They called me and they said, hey, I did a 1031. I had a sale 3 days ago. I want to do a 1031 exchange. And it was too late. Unfortunately, after a closing happens, it is too late to do an exchange. Before a closing occurs, we have to create the exchange documents, which is the legal mechanism that allows for those deferral of taxes. So if there's a closing and the 1031 exchange is not in place, unfortunately, it's a taxable event. So, that can be terrible. So it's important, just make sure you have a 1031 exchange company involved prior to a closing. So does an investor have to pay taxes eventually? Very possibly, right? So a taxable event happens, remember, when A, you make money, and B, you take possession of that money. So what an exchange is really good for is growing someone's wealth, right? And having it cash flow. At the time of death, they can always transfer it to their heirs, and their heirs can sell it with no taxes. It's called a step up in basis. So that can be a really great estate planning tool. I had a exchange client a few months ago, and she was in her 60s, and she was a former teacher. She had, when she was in her 20s, someone said, hey, it's really good if you buy real estate. So she bought I think a duplex, worked a summer, saved enough money for a down payment on a duplex. And about every 5 to 8 years, she 1031 exchanged it into a bigger property with better cash flow. She just exchanged into a 12-plex over in Mission Hills. And she said, Brandon, this is the last exchange I'm going to do, but I'm generating $12,000 above my expenses on this property. And she said, it's so life-changing to have this $12,000 a month. She said, I just couldn't have stayed in San Diego my whole life on a teacher's pension. And so, to me, that's really the value of a 1031 exchange, is being able to grow that value over time and have this great cash flow off of it. And then being able to transfer it to someone's heirs. But if they do sell it in their lifetime, if I 1031 exchange 2 or 3 times and I sold it, the IRS is going to tax it all the way back, because the government wants to have their portion of the money, right? They're like the mafia sometimes, right? So they're like, hey, I need my piece. You've made money, I need my piece. So anytime that someone does sell a property, if they've 1031 exchanged, sometimes there can be a big tax bill. Andrea asks, can the QI assignment happen at the last minute during escrow or before escrow? Yeah, so the 1031, you can set up a 1031 exchange at any moment prior to the sale. The buyer does have to be notified. We take care of that. We have a form that we print out, we send to escrow, and escrow forwards it to the buyer, letting them know, hey, it's a 1031 exchange. But a 1031 exchange can be set up at any moment before the close. Once the close happens, it's too late though. So that's really important to understand. Great questions, guys. All right. This is typically where I talk about what a 1031 exchange costs. Like I said, it's $995 when someone sells, $295 when they buy. That's significantly less than any taxes they're going to pay. There's 4 taxes that someone is going to pay if at the time they sell real estate. So the first one is long-term capital gains. That goes to Washington, D.C. That is either 15 or 20%, depending on their income. The second one is depreciation recapture. So if depreciation is a really important part of owning real estate, and it can be a great wealth amplifier, but when you do sell, you do have to pay 25% of that benefit back. Third tax is the healthcare reform tax, 3.8%, that goes to pay the Affordable Health Care Act or Obamacare. And then lastly, the state taxes, that we typically use 10% as a round number, but it can go as high as 14% here in California, depending on what someone's income is. When you add all those together, it's typically around 1/3 of their profits. So a 1031 exchange, again, is a little bit over $1,200 versus paying 1/3 of the profits in taxes. Judy asks, how long does a property have to be an investment till it qualifies to be exchangeable? Great question, Judy. So the IRS doesn't know what we do on a day-to-day basis, right? They don't know that we're on this Zoom, probably not. What they do know is what we tell them on our tax returns. So as long as someone has reported that the property is an investment on a previous tax return, then you can go ahead and exchange it. So you just have to tell the IRS, hey, this is an investment. And then once they're aware, then you can 1031 exchange it. Great question. Here's a case study. It's not rocket science. If someone sells and pays taxes, they have less money. If they sell and don't pay taxes, they have more money. And that can be a big difference per year in the income. So Judy, it could be 1 year, it could be less than 1 year, right? So if I purchased a property in October and then I reported it, on my tax return as an investment property, then really at any point after that, so it could be as quick as 3 or 4 months. It could be as quick as 1 month, could be as long as a year. Just depends on when you've purchased the property. You just have to let the IRS know first it is an investment property, and then it can be exchanged after that. Andrea says, can the investment property be their second property and qualify for a 1031? by second property, Andrea, I'm assuming you're asking if it's a second home, rather than a investment property. So the IRS has come out and addressed that, and they've said, hey, we know that sometimes people may buy a second property and potentially Airbnb it. And so where's the line between having a second home that you use for personal enjoyment or having a second property that you use for investment? And they have said, as long as you live in that second property less than 14 days, it qualifies as an investment. So as long as someone stayed in it for 14 days or less, then they can 1031 exchange it. If they live in it for 6 months out of the year, the IRS says, hey, that's really more for personal enjoyment. That's really not as much for investment purposes. Okay, let me answer the partnership question. So this is a very good question. So let's say that Judy and I bought a property together, and Judy decides through the life of this investment, let's say we've owned it for 5 years, Judy decides, I hate Brandon Burns. He is a terrible person. I do not want to be partners with him. We're going to sell this property, and I want to 1031 exchange my funds, and I want to separate from Brandon. Then what we would need to do is what's called a drop and swap. So we were in an LLC, Judy and Brandon LLC. We would drop out of Judy and Brandon LLC and go on title next to each other as tenants in common. They would say Brandon owns 50%, Judy owns 50%, and we could separate, and our actions would not affect each other. So let me scroll back up to your question here about partnerships. 1 second. So remember, there has to be continuity of the taxpayer, right? So when a property sells, the entity that's on title is the one responsible for it. You have to buy equal or greater to what you sold. You can't take any money out. But if we want to dissolve a partnership prior to the sale, we would drop out of that partnership and we would go on title next to each other as tenants in common. Once you're tenants in common, you're only responsible for your portion. So if it's 70-30 and I'm 30%, I'm only responsible for my 30%. I could, if it's $1 million property, I only have to go buy $300,000 replacement property. In that situation, Judy, as a 70% owner, would have to go buy a $700,000 replacement property for her to avoid all taxes. If she decided not to do an exchange and I did an exchange and I bought equal or greater to my 30% of $1 million property, 300,000, then I'm fine, and my actions don't affect Judy and Judy's actions don't affect mine. Does that answer your question, Amy?
It does. And to add on to that question, because that's exactly what it is. It's a brother and sister. One owns 70%, one owns 30%. The 30% owner wants to reinvest. However, the 30% owner wants to reinvest with his daughter, and I believe the daughter is going to live in the property. Can that be done?
Yes. So when it says reinvest with his daughter, does she need to go on title? What does reinvesting with a daughter look like?
I believe the daughter is going to move into it.
Okay.
But that's my understanding.
So you can definitely have a renter that's a family member, right?
Okay.
So if I bought a property as an investment and my friend lives there, my child lives there, my mother lives there, as long as I don't live there, it's an investment for me. So they're paying rent, doesn't matter who lives there. So what the IRS is just going to look at is the flow of money and how title is held. So what they need to see how title's currently held. If they're both in an LLC and there's 70-30 ownership of the LLC, they need to drop out and swap to go on title next to each other. If they currently are next to each other as tenants in common, we need to see if it's joint tenancy. It still needs to be changed to tenants in common. So as long as they're tenants in common, then the 30% owner can go buy something else. Now they have to buy equal or greater. They could buy the replacement property fully in their name. They could buy half of it in their name, and they could have a partner for the other half. The IRS is just going to look at, did they buy equal or greater to the portion that they sold? So I'm certainly glad, if you want to get with me later today, I'm certainly glad to do that. We can pull title, we can look at how it's held, and we can look at the exact numbers that are needed for that situation. No problem. Judy asked a question. Good question. What if a duplex and live in one unit? This happens occasionally. I literally just did one where there was a gentleman who had lived in a fourplex for a long time, lived in one of the units, rented out the other third. In that situation, in a duplex, like what Judy asked, the property would be divided according to square footage, and the part that someone lived in would be their primary residence, and the part they didn't live in would be an investment property. So in a duplex, theoretically, someone could qualify for that 250 or 500,000 tax-free under selling their personal residence, which their half, and then they could 1031 exchange the rest into another property for the investment portion of it. So with a duplex, sometimes you can combine if someone lives in one side and does not live in the other. If they don't live in either side, then it's just a normal multifamily unit where it's all investment. And so it still follows the rest of the rules for the 1031 exchange. Does that answer your question, Judy? Okay. What else? You guys are giving me, these are great questions. This is amazing. I'm really glad that hopefully this is helpful and can help everyone on this call make more money. That's really my goal, is that everyone on this call is able to do at least one more transaction, right? Because sometimes 1031 exchange can help you pick up a listing. And I can talk about some specific strategies. What if it is a single family residence with a rented ADU? Typically that's treated as a duplex. Sometimes it can get a little bit tricky if there's only one APN number or one address. Typically, as long as there's two addresses, then you can treat it as a duplex. If there's only one address, then it typically needs to be treated as just one single family property. So, but as you deal with those, just let me know. We can pull a title report. We can take a look at it and get really specific answers for specific situations. One thing that we're seeing a lot of in San Diego, right, is this kind of wild increase in the value of property over the last run. But what's happened a lot is these owners that are not very sophisticated really enjoy their tenants. And so they haven't raised rents equal to the value that the property has increased. An example for this, I was talking to a young lady, and she had bought a property in Escondido, and it had an ADU in the back with the different address, and the front house was rented. She lived in the ADU, and she told me, she said, Brandon, I have the best tenants. They pay me on time. And you know what? They paid me this month. They paid me early. I said, that's great. She said, yeah, that $1,500 came in really handy. I asked her, wait a minute. So they paid you $1,500. What type of property is it? She said, it's a 4-bedroom, 4-bath house. And I said, of course they paid you early. That's such great rent, right? So what's happened is her property that she bought for $320,000 back in 2013 is now worth about $900,000, but she never raised the rent. I think she maybe raised the rent $100 at one point over the past 10 years. And so if you can find someone who owns property where they say, hey, we've got great tenants, or we really like our tenants, and they haven't raised the rents, then that can be a great situation for them and for you, because you can say, okay, let's sell this property tax-free. Let's roll you into a property where you have tenants that are paying regular rent. In that situation, it should be $4,000, right? For a 4-bed, 4-bath house in a nice part of Escondido, the rent is going to be at least $4,000, maybe $5,000. And so you can help them sell that property, buy another property, double or triple their income, and you get 2 transactions out of it. They don't pay any taxes. And another benefit is, in that specific situation, the tenants were asking her to replace the windows, and that was a $30,000 bill. And so if she ended up 1031 exchanging out of that home into another one, she almost tripled her income, and she was able to avoid a $30,000 bill. So that's important. I want to be respectful of everyone's time. So quickly, let me answer just one more a question. And then if anybody has any other questions, here's my information. Please email, text, call, add me on Instagram, message me. Kelly says, so the teacher example who owned the 12-plex, if she moves into the one at the unit and uses her primary, would she be able to claim the 250 write-off and deduct this some amount from the total gain? So at some point in her life, if she did sell it, she would be able to class it as long as she lived in that one unit for at least 24 months. She would be able to classify that portion based on square footage and be able to take some money out tax-free, but she might have to pay the rest in taxes if she sold, or she could potentially exchange the rest. So again, I want to be respectful of everyone's time. So thank you so much for listening to me today. Thank you so much for the great questions. And please let me know. And I'm certainly glad to dive into any situation with anyone at any point. And I'm here to be a resource.
Thank you very much, Brandon. Appreciated the nice presentation today. Everybody, here's your broker speak. You don't need to be the 1031 expert because you can't give tax or legal advice. So team up with somebody like Brandon. If you have somebody that says, I want to do a 1031 exchange, find a good exchange accommodator like Brandon, let them answer the questions and refer that owner to a qualified tax professional for their particular situation. That said, everybody have a great day and we'll see you later.